Hello, and thank you for joining me today. My name is Jackson Howell, and I'm going to talk about how U.S. monetary policy affected banking stability during the COVID-19 pandemic. Over the next few minutes, I will explain the main actions taken by the Federal Reserve, show how banks responded, and describe the risks we need to watch out for in the future. In this study, we set three clear goals. First, we look at the steps the Federal Reserve took in early 2020 to guide the economy through the pandemic. These included cutting interest rates, buying bonds, and creating special lending programs. Second, we assess how well banks held up under stresses by measuring their capital levels, cash reserves, and profit trends. Third, we highlight long-term concerns such as rising inflation and the chance that banks might expect future bailouts, causing them to take bigger risks. By focusing on these objectives, we can judge both the short-term success and the long-term trade-offs of aggressive monetary policy. The Federal Reserve used three main groups of tools to stabilize markets. The first group was traditional tools, which included slashing the federal funds rate to near zero, launching large-scale purchases of government bonds, known as quantitative easing, and conducting overnight repurchase agreements to lend cash to banks. The second group was liquidity measures, where the Fed encouraged banks to borrow at the discount window and temporarily set reserve requirements to zero so that banks could use all deposits for lending. The third group was dedicated facilities aimed at specific markets, such as the Money Market Mutual Fund Liquidity Facility, or the MMLF, that backstop mutual funds, and extensions to the discount window for foreign branches. Together, these efforts kept credit flowing when it was needed the most. To support non-bank investors and key credit markets, the Fed rolled out several special facilities. The Money Market Mutual Fund Liquidity Facility, the MMLF, used $10 billion of Fed equity to guarantee short-term assets held by the money market funds and stop massive outflows. The primary and secondary market corporate credit facilities allowed the Fed to buy newly issued and existing corporate bonds. This kept companies able to borrow money to pay salaries and bills. The Municipal Liquidity Facility helped state and local governments issue debt at favorable rates, giving them cash for public services. Altogether, these programs poured tens of billions of dollars into markets that were close to freezing up. Banks entered the pandemic stronger than before, thanks to reforms after the 2008 global financial crisis. New rules required them to hold roughly twice as much capital and 3 times more high-quality liquid assets, such as cash and government bonds. Each year, the Fed's stress tests forced big banks to prove they could survive a severe recession. In early 2020, bank profits dipped but did not collapse, and by mid-year they rebounded quickly. Strong capital buffers and ample liquidity meant banks could continue lending and absorb losses without needing immediate government bailouts. This resilience bolstered confidence among regulators, investors, and the public. While aggressive Fed action kept the economy afloat, it also introduced some new risks. First, massive money creation and government spending could push inflation above desired levels, eroding purchasing power for households and businesses. Second, moral hazard may grow if banks and investors expect another Fed rescue during the next crisis. They might take an excessive risk knowing losses could be backstopped. Third, without clear exit plans, winding down emergency programs could disrupt markets. To avoid these pitfalls, policymakers must balance rapid intervention with well-defined rules on how and when support ends, ensuring stability without encouraging reckless behavior. In summary, the Fed's swift and forceful measures in 2020 prevented a deeper economic slump by cutting rates, buying assets, and creating targeted facilities. Post-2008 capital and liquidity reforms gave banks the strength to weather the storm and recover quickly. Looking ahead, we should learn from both 2008 and 2020 by designing crisis tools that can be activated fast and retired cleanly once conditions improve. Clear guidelines on the program limits, communication strategies, and exit criteria will help maintain market stability while reducing long-term risks like inflation and moral hazard. Thank you for your attention.